Hi, in this episode we discuss the commodities market, which is very likely the oldest market in history. The roots of the commodities trading can be traced back to early human civilization. For example, a farmer may have traded his agricultural produce for some jewellery or firewood. While bartering may have been replaced by money and currencies, the commodities market, and more specifically, the future prices of commodities market, remain relevant today. Mainly to protect against major price swings, it is in the interest of both commodities producer, like farmers, miners, oil riggers, and commodity buyers, like food processing companies, to have an agreed upon price in the future. Today, retail traders can also participate in this market, trading commodities CFDs. For those interested in trading in commodities market, we are fortunate to be able to learn from Desmond Leong, founder of Rockqet, a community building platform for brokerage firms. And as usual, we have Timothy Ho, our co-founder and managing editor at DollarsAndSense. Thanks for joining us, guys.
Thanks.
Okay, so we've definitely come a long way from ancient humans, where they used to barter and exchange goods. Timothy, can you briefly describe how the commodity market works today?
Okay, yeah, you're right, we've come a long way. So the commodity market today, you can think of it as a financial market where people buy and sell commodities, or they just trade commodities, right? We may not need the raw materials, but the manufacturers who give us, our jewelry or our food, that we see in the supermarket, still need those raw materials in order to manufacture these products that we eventually buy.
So the prices of commodities affect our daily lives, right? So what are some macroeconomic conditions, that maybe we should pay attention to as traders and even consumers?
Commodity prices are largely determined by supply and demand, right? So if you have a supply shock, so the most common is weather. Soft commodities like agriculture, your corn, your soybeans, weather is the number one determinant of how the harvest will be next year. But the demand will generally remain consistent because people eat the same way. So then you naturally will have higher prices for that season. Currently, there's a couple of war ongoing. Naturally, things like your oil prices, certain raw materials will be in greater demand, and that may also increase the price.
So we need a lot of information on our hands then, right? So Desmond, you've been a trader, and you also provide award-winning research materials, for a number of years. So besides these research materials, what else do you and other traders should be looking at when you trade the commodities market?
What moves something like gold might not move orange juice, right? Same thing, what moves something like oil might not move like wheat. Some people just love orange juice, right? It's just more natural for them to be involved in trading that, right? I mean, a lot of traders in countries like India and Thailand, sometimes they only trade gold, right? And so it becomes very second nature for them to understand everything about how gold moves, right? So first, you must have the interest in it, right? The other things that we consider, macroeconomic factors, right? We've seen it, I think, in the whole of 2023, right? We have inflation, right? Inflation keeps going up, right? Of course, that also affects the prices of a lot of things.
And interest rate as well.
Interest rates also go up. Then there are the geopolitical kind of conflict. You got Russia-Ukraine war. On one side, it can actually push the prices. What happens when there's such war? People go into a very, what we call a risk-off environment.
Does it matter what kind of trader you are and what kind of information you'll be looking at?
Yes, exactly. So for example, something like the Russian-Ukraine war affecting oil prices, for example, right? It is very unlikely that if you're looking at the 5-minute charts on oil, right? What's happening in Russia and Ukraine is not going to affect it much, right? Looking at the next 5 minutes that happens, the bar forms, a lot more based on technicals, right? Supply demand than something like a big news event like that, right? So some people are longer term traders where you would naturally need to focus a little bit more on the big news factors that are moving the markets. There are traders who are pure technical, right? They're okay, I don't have the time, to look at all these different news items, flying around the place, and they still want to trade commodity CFDs, right? So what they do is they jump into the technicals instead.
How do you invest in things like gold and even other commodities that we've spoken about?
There are many different ways of investing in a commodity such as gold, right? So in the olden days, it's just taking possession of that gold. So you literally just go to the goldsmith or something, you buy the gold and you keep it at home. Gold, silver, things like that, metals are actually very heavy. And of course, when you buy it, you also have to take into consideration the transportation costs, storage costs, and if you put it with someone, maybe insurance costs as well. So there is a cost to owning gold, and it's quite cumbersome if you own the physical gold. So you have things then like gold certificate, which basically represents a claim that you have on a gold that's somewhere in some vault or something like that, right? So then you have gold certificate, a little bit more portable. You can do it through gold ETFs as well. So gold ETF is a way to get exposure on a fund that invests in gold. And then of course, you have gold CFDs as well. And what you're doing is you're getting exposure to the difference in price of the gold, whether it's a long position, which means you believe price will go up, or a short position, which means you think price will go down.
Okay. So Desmond, what are the main differences then when you invest in gold, whether physical or through the ETFs, and versus you trade gold through the CFDs?
One of the big benefits of CFDs is that it actually allows you to kind of go both directions. And not only like if you're bullish on gold, you say, all right, we're in a risk-off environment, stuff happening, right? There's a likelihood that gold will rise. Yeah, you can invest in gold, you can buy gold CFDs, but when the opposite happens, right, you start to notice that gold is maybe because of your technicals or the news reports that you're reading, right, and realize that okay, maybe gold is a little bit overbought, right? It might be due for a reversal soon, right? And that is where CFDs give you that little bit of flexibility to go in the opposite direction. Some of the additional benefits that you might not get in like maybe in ETFs or just pure buying gold bars, right, is the leverage. Your money, you can buy more with a certain capital that you have, right? And of course, the fractional nature of like being able to start with less, and of course with leverage, right? That's where you can trade gold CFDs, get in and out faster, and of course transaction cost is less also.
Building on cost, I'm also wondering like what are the different types of costs that we incur when we invest versus when we trade then?
Yeah. So when it comes to commodities, commodities by itself don't give us a return, right? So it's not like investing in a stock or bond where the company or the bond can give you an interest rate or a return or dividends. Commodities are just commodities, right? In fact, you incur a cost when you buy commodities. So if you buy physical gold, there is the spread, there is the transportation, the storage, the insurance you have to pay. If you buy it through a gold certificate or a account, right, there is a transaction cost. They might also charge you a fee for keeping the gold certificate in the account.
Fee.
Yeah, a recurring fee, which could be a proportion of your portfolio, your asset. Same for ETFs, right? There is a management fee associated with that. When it comes to commodity investing, there's always these transaction costs to take into consideration. There are other factors like foreign exchange, because we are here in Singapore, so whenever we buy gold, we pay in US dollar. So even if the gold prices go up, but the SGD depreciate against the USD, we actually don't get as much of that gain because of currency fluctuation.
And in the CFD markets, how does the cost weigh against investing?
There'll also be the holding costs, the financing fees. These are stuff when you hold a position like overnight, right? So for example, if you bought a physical bar of gold, you have it with you and you put it on your table, right? There is technically no overnight cost, right? If you use trading CFDs, right, that's where, of course, you leverage, right? You have that the overnight financing fees, right? So hold it for 10 days, hold it for 20 days, 30 days, it'll be more expensive, right? So that is one consideration you have when it comes to trading CFDs. That the spreads are good, right? But you do need to keep an eye on the overnight fees.
Okay, so like any financial product, we need to understand what we're investing in before we start trading, right? So Desmond, when you first started traded, what were some things that you did that helped you understand the markets and become a profitable trader?
In the world of trading, sometimes you go on YouTube, you go on forums, you might end up reading the wrong stuff, right? So one very important thing to do is look for trusted resources. For education, for learning. ONDA is a very good learning resources they can refer to, but brokers do have their own, the first level of filter that they put through, that the content, the stuff that I'm going to teach on my website has been through like some kind of, it's been vetted already.
If you are on the wrong side of the trade, you don't just lose what you put in, you might lose more than what you put in, right? Because you don't have enough time to exit the market. So things like a guaranteed stop loss, those are actually bread and butter. It's required for any traders when it comes to risk management. Otherwise, you are in some sense just speculating. You're not trading with all these probabilities, risk-reward ratio in mind, right? So I think those are vital.
I agree.
I guess to wrap it up, like another tool that CFD brokers do provide is also a demo account. So you may have your strategies in mind. I know you say don't wait too long before you test your feet, but at least you should test it out before going live, I feel.
Yeah, I do agree on the part that if you can't do it on demo account, you can't do it on live account.
So it's a bit like going to the swimming pool to learn, right? If you want to learn swimming for the first time, you learn at the 1 meter pool.
Yeah,
right?
correct.
And once you are comfortable in that, you must go to the 1.8 meter, right? Or even the sea in the future.
Thanks, Desmond and Timothy, for your insights on the commodity trading industry. As discussed, there are many similar risks that exist in all trading instruments, right? Whether it's CFD or investing, and commodities trading is no different. In particular, certain economic factors, including supply and demand that we've talked about, as well as geographical risks, geopolitical risks, volatility, and weather conditions. They all come together, and we need to be aware, mindful of the components, as well as where to go to get more information on these components. So we should pay attention to all these things. When choosing a CFD broker, I think we also said, to reduce our risk, we can choose to first invest with a MAS regulated broker, someone we trust, someone MAS also has put their stamp on. We can also utilize stop loss orders and orders with CFD brokers to limit and cap our downsides, and also practice our trading strategies with a demo account first, to quote your analogy again, swim in the 1 meter pool, then get some skin in the game, go to the 1.8 meter pool, and finally, take that risk in the sea.
See, yes, right.
All right, thanks guys.
Thank you.
Thank you.